Please subscribe, like, and hit that notification bell. Thanks, guys. Hey, guys. All right. So I'm going to go through some of the charts I've posted on Twitter. There's not much, like the tweets, you can't write too much into it. We keep the in-depth discussions, commentary, of course. That's why North Star Charts, Kevin Wadsworth and I started North Star Bat Charts. When we post these charts on our website, there's more communication with the members. We're there for them. There's a comment section. We discuss with them the charts. We can nuance them, etc. But on Twitter, guys, it's like you put a chart there, you put the annotations, and then like if we could help you through the tweets or responses, we can. But that's it's difficult to do through Twitter. The best is on the website, get our attention, and then you could see how the weight of evidence, all these charts, how they fit together. Because sometimes we put on Twitter the big picture charts, and what you don't see is on the website, we actually have a trade tracker where we talk about our entries, our exits, how we apply sound risk and money management, how we do all what a professional trader, everything, the framework that encompasses it, that is available to our members on the website. So yeah, Twitter is great information. If it could help complement any one of your own trading framework, that's fine. But if you want a full service, then that is more on the website. But look, this is on YouTube. Hopefully you guys, I'm going to try to nuance some of the recent charts I did on Twitter, and hopefully it gives you value and you'll see more. It'll help you understand maybe my next charts I'll do, see what my thought process is and the way I see the markets right now. So look, guys, this is the most simplest way you could analyze a chart. It's two lines. I call it the sleep mode line, and that's just for your brain to register that below this line, you should be asleep, like a bear hibernating. You should not be involved into a stock when it's below its sleep mode line. It's a rising trend line. It often matches the 12-month moving average, the 1-year moving average. You see here when it broke down Tesla. This is a log scale. So already it's not able to do as high as it was above the 12-month moving average. It does a new high, but it's slowing momentum. I could have drawn a dome here, and you can notice that that's showing you that the momentum is slowing down. So as soon as you're below the sleep mode line, you should get out. Oh, Patrick, it went down from 480 to 360, and then you see that as a percentage loss, but the percentage loss could be much worse, and you could drain your emotional capital while that goes sideways for months and months and months. And that's what it's did, and it's actually drifting slower. So now it stayed below the sleep mode line, below the 1-year moving average line, and now every time it did a rally, I'm able to draw a wake-up line here. Each of these swing highs, it's wake-up line. And that one also, just like the sleep mode line, is going to track the declining 12-month moving average. So you're in no man's land right now. Tesla is no man's land, but there's no reason to hold and pray and hope it breaks above. If it breaks above the wake-up line and the 12-month moving average, fine. Based on that chart merit, you could say, all right, going back up, it's a consolidation like we did here, and we move up. That's fine. But when you're here, you're at risk now that 3-year moving average is catching up. It could break down by the end of the month. If it closes, even here, there was a breakdown line that it right there. Here's a more final breakdown line. If it closed the month here, it's in the bad zone. So now the rallies will probably get sold instead of bought. You're on the wrong side of the momentum. Capital flows are leaving Tesla and going somewhere else. So this brings me to my second chart, guys. It's the gold versus SPX. So SPX has a lot of growth stocks in it. Maybe at the end of the commodity bulls era, the sectors will be more heavily loaded, basic materials, commodities, energy. Until gold breaks out versus SPX, there is no precious metals bull era. And that, all the capital flows, I've shown these charts, guys. A lot of the gold miners, silver miners, uranium miners, platinum chart, all that, I could overlay it on this chart, and it tracks the ups and downs of the gold versus SPX ratio. So this is the Rosetta Stone, which is going to unlock everything. You want this to break out convincingly, and this is a beautiful basing pattern, thinning cloud. This is resistance, declining resistance here, that red cloud, thinning, The price action is hogging the 3-year moving average, flattening out. This is what you want to see a base. The hard move down, it's done. Now it's been consolidating for 5, 6, 7 years. This is beautiful, but it's not quite time to pull the trigger. High or low, you could think, oh, this is it. Well, look at this rally from 2018 all the way to 220. Gold moved impressively on its own chart merit, but that was just a bear market rally within the downtrend. It didn't even close out of the cloud, got dragged back in. So that was a appetizer, but we're not quite there yet. You really want to close above this early breakout line. You want to close above this, start getting excited above this line. You want to close above the final breakout line. And sure, yes, the miners will have moved hundreds of percents, but you have to see a big picture. At the previous cycle, once gold can close above all this, get all these positive bullish clues, then the dips, you buy them. Then you know that you have the tailwinds of the capital flows. They'll be losing capital flows. They're leaving the stock market as it crashes. They're even leaving gold. But when the money starts going back in the markets, they'll favor gold, silver, the miners, all that, instead of going the SPX. And that's why this ratio is going up all the way up here. And then you have a beautiful new cycle. You see when it breaks down here, then you're out. And then after that, you move on to whatever's outperforming it. Here, there's a little zoom on the 1 hour chart, keeps grinding upwards. But just that, like months of tracking in the 1 hour chart, it's just a few candles here. So this is a lot of noise. So keep this in mind, guys. But now I'm going to add some evidence to showcase why we could be expecting a turn. But until gold does break out versus SPX, this is just evidence, not to buy the dip, but for your managing your emotional capital, your timing of this, how long do I have to wait? That's the most favorite question. Well, you want to see the indicators that have marked bottoms or turns in the instruments you're looking at. You want to see where they are. So this is my total public debt saturation. So it's a total public debt multiplied by the Fed fund rate. And with the latest Fed fund rate increase times the public debt that exists, it's like the saturation of the markets before something, they need to do a pivot, they need to lower the Fed fund rate or lower the debt to do a cleansing cycle. This is 2020, the 1920 right here, where the Fed fund rate was too high, so they had to pivot and to lower that pressure valve. 2008, they had to release that pressure valve. 2000, all these, we know that these were turns in the precious metals. There was an unwind here, and look where it is here. So it's fair to assume that now we're above these levels. We just have to wait until this turns back down, guys. So the fuel, see this as fuel reservoir. These are fuel that once this turns, it'll get consumed. It'll help SPX. But if SPX is breaking down versus gold, or gold is breaking down versus SPX, then this will fuel gold, silver, the miners more. So even, let's say we have the case where SPX goes in a melt up, but it's still underperforming gold and the miners. Who cares if SPX is doing a melt up? You want to be in the assets which are outperforming the other ones the most. Here's another big picture chart that goes in line in conjuncture if that unwind of the total debt saturation unwinds, cleanses, if gold breaks out versus SPX out of these 10-year patterns. Well, look at this one. This is the purchasing power since 1914 for the US. It's always been going down practically, right? Yes, there's ups and downs, but practically top left, bottom right. And this is the rate of change, 8-year rate of change. So the rate of change actually tells you, even if it goes from top left to bottom right, the rate of change tells you the fluctuations, the speed, the accelerations or decelerations in that destruction of purchasing power. And when these things unwound, these were bear markets for US equities, bull markets for commodities. Look at this here. Late 1960s, this was a bad zone for your purchasing power, but that was reflected into gold, silver, oil, commodities going upwards. Like that, we have a 40-year or 30-year topping pattern as purchasing power reflated, but never positive. So it's reflating below the zero line. So it's just decelerating less on the 8-year rate of change. And now it broke down, guys. 1, 2, 3, 4. Like this is a beautiful breakdown, a huge pattern. We're in the bad zone. So until this closes back above the early breakdown line, you have to assume that we're in a phase of destruction of purchasing power. So add this evidence, this conjuncture with the gold to SPX creating a base, starting to turn up. This could be very positive for all of precious metals. As soon as gold breaks out versus SPX, it is set up properly. Purchasing power is not here rock bottom like it was in 1980 or rock bottom like it was in 1949, 1950, right? That's the fuel reservoir. Here, fuel reservoir is empty. Fuel reservoir is empty here for precious metals. It's still top level, and it's just starting to get consumed, guys. Yeah, so we're having this in November right now, guys. A little segue into our website. All this type of information, these podcasts, Kevin Wadsworth, North Star Charts, and we cover this type of information. We're there to answer your questions, all on the website. And right now, for the month of November, there's 50% discount on all our packages, guys. So $1,750 for the premium monthly, $210 for the yearly, etc. Our premium plus, where you have private member, we have monthly master classes. We're there. We answer 3 hours of time. We're with you guys. Q&A, cover your stocks, all that. Private Twitter, $50 a month, or $600 for if you want to play for the yearly. And here, look, guys, you could go down through all these. Each one, you could click on them, the description of exactly what it brings you. So all of this is included for the 50% discount. And this is inflation proof, guys. So that might come to haunt us, but it is what it is. So $1,750 is for life. As long as you don't leave us, that'll be month after month. No matter if we raised our minimum price to $40, let's say in January, it'll still be 50% of the $35 you'll be paying. And yes, oh yeah, the heat map. Yeah, this is good. This is new. That's why Kevin and I, after we did the heat map, I said, "Oh, Kevin, we have to do some type of promotion to promote, to get people aware of this, because the heat map. I know there's like over 95 instruments. There's ratios, commodities, big cap stocks. There's everything, every sector. There's 95 of them right here, and we're able to see the health of each of these instruments and have the ticker from left to right, from the shorter term, medium term to the long term. How is it? There's even a score column here. Then you scored out of 100, our proprietary weighted scoring system. It's all there, scored. And then you see the change from the previous snapshot. So you could see the evolution. Oh, is it getting better? Oh, it's green. It's getting the breadth, or it's strengthening the trend for the stock, the sector. I want to be in that sector. Because if it's all red, guys, you don't want to be in these sectors when it's mostly red. You want to see the ones that are mostly green and increasing. And this, you'll see it with our change column. So the heat map is really, really cool. A lot of great feedback from our members. And honestly, I use it every single day. Before I do a post, I want to present the best post to our members. I always look at the heat map to see, okay, look, oh, this is strengthening. It wasn't too good. Now it's getting better. Look at that. It's turned green here. And then I do a post, and then I deep dive why I think that instrument could bring us a good risk to reward value. All right, guys. All right, copper, another piece of the evidence. I did this Schiff pitchfork right here, and Schiff, I think it's Andrew Schiff. I think it's like Newtonian. I really have to, I don't want to paraphrase this the wrong way, but it's ripple effects. So the energy in, energy out, it reverberates, and over time in the price action, that could be reflected. So just this high, low, high here created this Schiff pitchfork that you'll see over years and years and years. That's 1970. Copper loved to reconnect here in mid-1980s, reconnected here in the 2000s, mid-2000s, tried to reconnect here in the median line, but a little bit in the band in the 2011-12. Now it went sideways, a little bit like it did here in the drought, distancing, but it started moving back towards it. So this is not a confirmation of a turn in copper. It's not telling you go long copper. It's telling you that there's a possible arbitrage play in favor of copper. And here it gives you, it's just another technique to try to measure a target move, right? And here I saw from the bottom all the way to median was 320%. Bottom here, all the way to median 320%. So I know this is possible logical targets. And this goes back. So now that's the weight of evidence, right? Gold to SPX chart. If that breaks out, this is going to have a higher chance of going up. Destruction of purchasing power. If that momentum keeps going down that 8-year rate of change, that has a higher chance of going up. All these elements, they add up together, guys. Here I did that copper price index, and then I just added the 7-year rate of change with its 7-year EMA, exponential moving average. And look at that, guys. Look at the signals. Just to confirm, sometimes you can't see it on the price action. But look at that. When it closed above the 7-year moving average, bam, it was a strong move up. Sideways drift, close above the zero line, above the 7-year moving average. Look at that, bam, you had a chance of going up. It did it again, I think in 2021. It created this first swing move up high. So when the rate of change is expanded and everybody starts talking like, oh, commodities forever, high targets, you're going to look at that and say, oh boy, they're stretched. There's a lot of crazy stories out there that's going to go to the moon. You know better. But when it's at the bottom here and turning up, that's when it should garner your attention, guys. Crude oil versus copper. This is another one I put out and had to explain my reasoning. You could use oil as a proxy for inflation. So energy, big driver of the PPI, Producer Price Index. We have energy costs. It leaks into everything. So if your proxy, I could have probably done inflation chart divided by GDP without the inflation component in it, and it probably looked like that. So that's another rabbit hole I'll have to do. So I just wanted to see the cycles. It's a ratio chart. So you see 1968, it's moved. It hasn't gone linear, like bottom left, top right, like a SPX chart, right? It's a beautiful ratio showing you cycles rebalancing in between too much inflation, and then there's growth, and then there's less growth, and then inflation takes over, etc. It's always a battle, right? And it comes back to growth stocks versus precious metals, right? Destruction of purchasing power versus low rates, low inflation, higher price to earnings. So I did that. I found a median line. A lot of tests above and below, some spikes up. But you see, overall, this is a very important line, this ratio right here in the middle. We just bounced off it. Below, I put the ASA chart. I love the ASA. It's the Precious Metals Fund, gold and silver miners, but it's the oldest one I found that's still active. So instead of using the Huey or JDX or XAU, use this one. It has data since 1968. And if I overlay the GDX and whatnot, they're tracking this one pretty much. But here I just have more data, so it's more power. You get to see more cycles. So when inflation outperforms growth, you'll see that, and especially when it's above the median line, the precious metals, the gold and silver miners love it. They exploded higher. Here was a wave up here from the bottom, went up. Again, this is situate yourself. Am I at the end of a cycle or at the beginning, or am I transitioning right now towards a new cycle in my favor? And remember again, the gold versus SPX ratio starting to turn up, maybe trying to attempt a run on that breakout line. Well, it goes in line with this. Here it goes sideways, drifting down, inflation, stagnating versus growth. What happens? Gold and silver miners go sideways. Here a capitulation bottom, just like the 1970s, precious metals miner. But look at that. Here it was a move up above a pivot, early breakout line pivot, retest, and that marked the bottom for precious metals miners. Move up. Then here's a cycle where crude oil is outperforming copper, up and down, until the GFC, where it really hit inflation, and then growth kind of stagnated a little bit. But that was tough after that for precious metals miners to continue. So, but you notice the bulk of this zone up here was good, or the rise up here, it was good for precious metals miners. Sleep mode line, breakdown, totally inflation now underperforming growth until we bottom base here, just like we bottom based here. And look at that move up. It kind of looks like the oil chart actually, right? And if there's a reverse symmetry move all the way up here. Look, if inflation, crude oil could close above this line versus copper, and this wake up line, the price action is probably going to go sideways for gold and silver miners and even climb back above its pivot line. I put a pivot line right here also for gold and silver miners. When you're below it, you're historically underperforming. When you're above it, you're overheating, right? It helps mitigate your expectations. Have I burned all my fuel, or in the pendulum swing too far in one direction versus the other? Well, now it's starting to turn up. So we're getting really close Again, gold to SPX ratio. It still has some work to do. Gold miners and silver miners have a little bit of work to do, but the setup is there. The setup is there. We're not overextended. So that's the way you got to see that, guys. Please subscribe, like, and hit that notification bell. Thanks, guys.